There seems to have been a shift in correlation between bonds and stocks. First of all, do you think that means anything? Because sometimes we're just going to have those types of things happen.
Well, I think we've talked about this before. Good girlfriend, bad girlfriend.
I love it when we go back to the good girlfriend, bad girlfriend.
Yeah. Let's give her a name. How about Barbara? A good, handsome woman.
Boy,
she's a good girlfriend until she's not. We all have our limits.
So basically you're saying 465 is the equivalent of about 2:30 in the morning.
Yeah, 5%, 3 in the morning with the hickey.
Okay.
You know what I mean? Like, that's it, you're out. I'm selling. So,
things you will only hear on the Intelligent Investment presented by ARPG. Welcome back to the Intelligent Investment Show with Matt Dahl. I am Garrett Lill. Thanks for being here as always. Matt, pleasure to see you, man. I got to get a haircut again. I'm starting to get the mad scientist look again, like you were talking about a while back. You got to get me in touch with whoever does your hair or whatever your product is, because yours is the exact same every single week, and mine is something different every single week.
I got 2 words for you. Supercuts.
And see, I've been doing great clips, man. My bad.
There you go. There's your problem, right? You're kind of pulling off like the nonchalant, genius, kind of tech CEO guy. Like, I'll fix my hair when it suits me. Our
very last show of 2024 was the year of humility. I sing your praises, Matt. You get a lot of things right, okay? And we always make sure we point it out when Matt says something in that egghead brain of yours that comes out right. But I have to say, we closed our last show with you saying multiples are pretty high. You're expecting maybe a little bit of a cool down for a little bit. You don't see them getting stretched much more. You're not putting new money to work. That was January 10th. We're sitting here today, January 24th, year of our Lord 2025. You called the bottom. It is up 4.77% as we speak right now since our last show. So that's not a question. That's just a little bit of egg in the face there. I just want to say sometimes Matt does get it wrong. That's why, if you pay attention, at the end of every show, we say this is not investment advice or financial advice. We are only here for your entertainment or amusement purposes. And that's why, because Matt is wrong sometimes. It hasn't happened yet, but it did happen this time. So I have to point that out in full disclosure.
Yeah, I thought we were going to see sort of a 5,600 number in January. I don't think we're going to get that. However, I do see some consolidation happening here next week. Next week is a massive turbulent week, and there is likely going to be a move down into the 5,600 range. Like I said, sometime between the beginning of the year and March 15th. There usually is. February is usually a pretty bad month, but anything can happen, and no one wants to time the market. It's more about pricing fair value. And I think it will be probably a good opportunity to put some money to work next week. Two big things. Obviously, earnings are next week. And every single piece of good news is baked into this market right now. And you can see the market had this little sort of mini parabolic move, very similar to the election. What it was the inauguration. We got another bunch of speeches, pro-business, deregulation, and there's this another little bump in this Trump honeymoon. And as that starts to fade away, I think there'll be some opportunity. Earnings next week. We got obviously it's a big week of earnings next week. We've got Apple, Microsoft. I think Google's a week after. Amazon, Meta, Nvidia is not for a couple of weeks. Okay. Boeing is next week. Of course, they announced yesterday. That's my pick of the year. Now I'm absolutely going to double down on my pick for the year, Boeing, because they wrote everything off they possibly could yesterday, pre-announcing what the street was losing $1.80 a share last quarter. This quarter last year, they lost 47 cents a share, which means there is a 283% increase in loss year over year. Okay, great. Well, they went ahead and decided to pre-announce a $5.46 a share loss, which is a 1,064% increase in loss year over year. And the stock is holding. So I think a lot of that, there's so much bad news priced in. Everyone hates it so much. This is just when you got to own it, because if you can write off the kitchen sinks, your grandma's wig, and everything else involved, and it's down, I think, 1% or 0.5% today. That means a lot of that was already priced in. So hopefully, if they can stop doing what they're doing and actually make money. I mean, they're supposed to make $1.07 this year. If they can actually do that, I don't see how they're going to make $1.07 when they're now basically
$6.50 in the hole.
$4 behind the
Yeah.
behind the. Well, actually, I take that back. This is a Q4 2024 number. Their 2025 earnings are $1.07. So maybe they wanted to get this one out of the way. You know what I mean? So they could actually maybe exceed earnings estimates for there. I don't know, but hey, this is one of those things where this is when you buy. But again, we've got Apple consensus is $2.35 a share on last year it was $2.18. So about an 8% increase year over year. Microsoft similar $3.11 a share to $2.93 a year ago. So about a little over 6%. Those are kind of your blue chip techies, right? Google looks strong at $2.12 a share. It's almost a 30% increase from last year. Amazon, $1.48 a share is consensus, 48% increase over a year ago. So it's, that company is just absolutely knocking the cover off the ball every which way they can. Meta, same thing as Amazon, about the same as Google, about a 29% increase year over year. $6.84 a share is what we're looking for next quarter. NVIDIA, the big one, the Louisville slugger of it all, 84 cents a share on a 52 cents a share last year. It's about a 62% earnings growth year over year. So when we bought it, we always like to buy it. And so at 30 times earnings, you're buying it at a 0.5 peg with actual growth. And we don't see any slowing down of this. It might cool down to 40%, 35%, 50%, whatever. But that's a 61.5% year over year. And that's just the consensus estimate, which means they're probably going to post $1 a share, which could be, you're talking about an 80% growth year over year, and on a $3 trillion company. So that's just we're just going to maintain that position. That is our biggest conviction position. Although it's not my contrarian pick for the year, because if you don't know NVIDIA is a good buy now, well, I think you have been. I'm going to quote The Simpsons now. You've been in Mars living in a cave with your eyes shut and your fingers in your ears. So, but we have on top of earnings with a lot of big estimates are in there. Okay. A lot of earnings growth are baked in, as we can see now. Huge earnings growth this year or this quarter. We've got FOMC next week. We talked about this a lot in the fall that the Fed has kind of pivoted away from the inflation number more to the labor number, right? They're really concerned. They want to make sure that they don't overdo it with labor. They don't want to make labor get too much slack in labor because they don't want to have to unring that bell and bring labor back. But labor got tighter. So I think you're going to get a surprisingly hawkish Jay Powell on Tuesday. Okay. I think that could move markets down and kind of provide that buying opportunity that we're looking for. My guess there's going to be some key words that the streets are really going to focus on in the press conference. And I think that key word is pause, maybe hold. We have signal. The labor market's tight. Inflation has cooled. And the last thing they want to do is reignite inflation. Okay. So my guess is the street is going to price in during this press conference maybe one less cut for the year. And that could be, that could cause some turbulence. So, but again, the market it'll probably bring the market back to kind of where it was about the election, about that 5,900, 6,000 range, which is about normal. So there's just too much earnings growth. There's too much optimism. There's animal spirits. They're like, put me in, coach, put me in, coach, put me in, coach. This thing looks like, I don't think it's going to take off yet, but it's getting there. Okay. And when it goes through another a turbulent cycle, through an earnings cycle, through an FOMC meeting, but if we get into February and we get a cool CPI number and we don't get an overly hot jobs number, jolts don't come in too high, anything like that, I think we could actually have a pretty good February. And I'm going to maintain, I think we could see a really strong run up in through the summer, and then, have your typical exogenous, whatever takes place. We always have that kind of that week period. It's more of a cycle thing too. We get a 10% correction or so, north of a 10% correction about every year and 3/4, right? About 1.8 years. And about August will be 1.8 years since the last one, which was October of 2023. So it's kind of, there's a lot of, cycle composites in this, and a lot of farmers almanac or stock markets almanac kind of thing going on there. But I don't think it's out of the realm of possibility that the animal spirits could just be released after, especially if earnings are strong.
I love the line. You were talking yesterday, and you just dropped the line, land of confusion. This tug of war that's kind of going on between labor markets and the data from labor markets and the inflationary data, and how it's kind of some tension or tugging back and forth going on there. So,
well, we've had just this move in yields has continued into the new year, right? And we started the year at 457. It went all the way through. I think last time we were here, we were basically 475. It touched 480, 481. And that came off the heels of a really hot jobs report that, in early January, 256,000 new jobs added on 153,000 consensus. So the labor market's tight. We're down to 4.1% unemployment from 4.2. Not sure how much of that is seasonal because that's December's number, but that was, there was a lot of that was baked in. How much of it is, again, sort of this Trump effect that no one's really sure about yet. But subsequent to that, we had some pretty good inflationary numbers that cooled the yields down a little bit, right? We had PPI come in last week. Core PPI month over month came in at zero month over month. And we had some hot PPI numbers in November. So I was expecting, typically because PPI front runs CPI by about 3 months, I was expecting a hotter than average CPI number this month, even with a cooler PPI number. But then the CPI number came in 0.2 month over month core on a 0.2 month over month consensus. So again, you're talking about 2.4, 2.5% annualized with that number. Still not at the Fed's preferred target of 2, but that's CPI. I'll be curious to see what happens with PCE next week. My guess is it'll probably come in 0.1, 0.2. And that's the preferred gauge for the Fed because they don't use imputed prices with PCE. It's just how money is actually spent, which is a little different. So that gets us back to this sort of land of confusion is where does that, with a 10-year sitting at, basically 460, 470 and a policy rate at 4.5, where do we see the multiple going? Okay. Right now we're at 22.2 times earnings right here as we sit here today. So how much room do we have for multiple expansion? I don't really see much. We're already pricing in about a 14.5% earnings growth rate this year. Okay, so a 22 plus multiple on a 14.5% earnings growth is pretty strong. Okay, it's fair. Don't get me wrong. It's nothing wrong with it. It's fair. If we had a 19 times earnings, I would say, well, a 14.5% growth rate is a pretty good deal. Or 19 times multiple is a pretty good deal at almost a 15% growth rate, right? But that's a fair relationship. The kicker here is what's the risk-free rate, right? Because the earnings yield on the 10-year Treasury note is basically sitting at 22, right? The earnings yield on the S&P is sitting at 22. So we have parity now between earnings yield on bonds, basically, and earnings yield on the market. But of course, there's tremendous more volatility in the markets, and that's the risk that you take. So what will move the markets up from here if it's not going to be multiple expansion? Because we don't, like we talked about before, we don't necessarily see a massive contraction of interest rates this year. I think there will probably be a general range that the 10-year floats in, 3.5 on the lower end, maybe 5 on the upper end, 4.75 to 5 on the upper end, and we're closer to the upper end. But with obviously the Trump honeymoon is still in effect. And his inauguration happened since the last time we talked. And he was very pro-business with all of his speeches. And yesterday in Davos, he doubled down on do business in America, do business in America, do business in America. And I want American companies to be able to do business internationally without the threat of tariffs. And and these fines that are being levied by these European countries on our big blue chip companies, our Metas, our Googles, our Microsofts, our Apples, right? It's just a form of taxation. Okay. And he's not wrong. They are. That's what they're trying to do. So they tariff the products coming in, and then they basically generate some regulation that they know they're going to be in violation of, and then fine them for it. Right. That's what he's coming up against. So not to get too much into that, but the general narrative is there's going to be a lot of free trade taking place. What the final version of that is, I don't think anyone really knows yet. Okay. But there's going to be more free trade. There's going to be more American products on international shelves at a lower price point, probably very soon. So, I think the market has some of that priced in, being that we're 22 plus multiple, being that we have a 14.5% earnings growth rate kicked off after we've had, 20 plus years in a row. I think there's going to be, but what could sort of throw a monkey wrench in the whole works is, Trump himself, and not to get too political here again, but Trump said the world needs to lower interest rates. Well, that could be a problem now. If you're talking about a very pro-business president like he is, a very pro-free trade president like he is, in a very free trade global environment that we're going into, and you have cheap money to do it, that is a recipe for inflation to just take right back off. You know what I mean? Everyone can get everything they want. The demand curve will absolutely go parabolic. Okay. And that's not going to be good for inflation. So I think the Fed knows that. And of course, I am a fan of the separation between monetary and fiscal policy and the Fed staying independent. And I think that needs to take place. And I think it will. And I think the Fed knows that. And I think it's more political bluster than anything else. But as long as they're holding monetary policy, and back to, the rate cuts for this year, rate cuts because of the CPI and the PPI numbers. Last time we talked, I think we were like a one rate cut price in for the year based on the chart of CME. It's now up to 1.6 because of those numbers. And I'm going to still hold sort of this 3 + 1 - 1, so that 2 to 4 range. I think is where we're likely going to end up, because shelter came in 0.3 month over month in the last one, and last year those were coming in at 0.6 and 0.45. So the year over year number on shelter should really start to go down. And I think that's really going to cause those CPI, PCE, and PPI numbers to really start to drop. And I think that will be a good tailwind for policy rate, good tailwind for the shorter end of the curve, right? But I think that middle and longer end, that 10, 15, 20, 30-year end of the curve, I think is going to stay. I think it's going to hold. I think, like I said, I think the bottom end of the 10-year is 350. But I really don't see the 30-year getting below 4. Okay. So again, it's going to be at what point of the yield curve do you want to start picking and choosing? So that's kind of what we're thinking so far.
Another thing I wanted to ask about, so you got to be careful sometimes not to take little things and turn them into big things, and I get that. But it is interesting to me. There seems to have been a shift in correlation between bonds and stocks since our last show 2 weeks ago. First of all, do you think that means anything? Because sometimes we're just going to have those types of things happen for random reasons. It could be, you may have the answer to that. Or is there anything that's fundamentally changed to cause that correlation to shift? Or is that just blip on the radar, nothing to think about?
Well, I think we've talked about this before. Good girlfriend, bad girlfriend.
Awesome. I love it when we go back to the good girlfriend, bad girlfriend.
Yeah. Let's give her a name. Let's call her Debbie.
Tiffany.
Oh, Tiffany or Debbie. Tiffany.
Amber's always a dangerous one from my experiences.
How about Barbara? A good, handsome woman. a big, handsome woman named Barbara with curlers in her.
Boy, we digress.
She's a good girlfriend until she's not.
That's
so
right.
Where were we at the beginning of the year on yields? 457. Where did we go through January 10th? We went to 480. Okay. So what happened to the market? It pulled back through that time, okay, a little bit. Then we started to have some data come out subsequent to that was yield negative, bond positive, started bringing the yields back down. And the market liked that. So the market will accept higher yields to a certain point. We will accept a bad girlfriend to a certain point. If you come home at 3 a.m. smelling like cigars and you're walking funny, then no. Your bad girlfriend, I'm not going to accept that. So, if you're out with girlfriends a little bit longer, that's okay. That's where the market is at 460. That's about the number the market doesn't like. Okay, and there's no tried and true number for this. That number that threshold that the market likes moves around based on many things, based on forecast earnings growth, based on the current economics of what's taking the GDP and obviously Trump. Okay. So I don't know that the market would be okay with a 460 10-year if we had a different president in there right now, not a pro-business president in there. Okay, I don't know if the market would accept a 4.6 10-year and a 4.6 10-year with a 22 plus multiple if we had earnings growth coming in at 9% or 10%. Okay, I don't think that would be okay. It's a combination of all of it. Okay, but like any boyfriend or husband, okay, we all have our limits. That limit's around 460, 465. Okay, so
basically, you're saying 465 is the equivalent of about 2:30 in the morning. That there is a limit of how late you can come home, and there is a limit to how high you can go with yields, and that's around 2:30 in the morning or about 465.
5%, 3 in the morning with the hickey.
Okay.
You know what I mean? Like, that's it. You're out. I'm selling. No.
Things you will only hear on the Intelligent Investment presented by ARPG.
So I think it's important that we sort of delineate between, well, yields went up, but they were already right at that sweet spot when we started the year, and it went up from there, and then it came down from there. So the market is still pretty yield sensitive. It's just that threshold is moving around a little bit as far as where it starts to move back and forth. And, we're sitting at 460 today. The market's pulling back a little bit, not too much. I think what the market is doing right now, it's getting ahead of next week's big week. It's just one of those massive economic earnings week. A lot's going to happen. The market's going to move around a lot. Doesn't matter how good or bad the news is. There's just going to be some turbulence.
If the quality of my question can be graded by your answer, that is the best question I've ever asked, because that's probably the clip of all time right there. You mentioned Trump, and it was funny. Somebody told me the other day that they were expecting a bigger rally after inauguration than we got, and I kind of joked with them. I was like, no, the market priced in Trump being president in October. You missed that. But then you made a good point there a minute ago that there has been a little bit of a rally around that because you're getting more speeches. You're getting a little shot in the arm reminder of Trump being pro-business and also hearing him say some things maybe that were not – you knew he was going to be president. You didn't know what he was going to do once he got there. So there are opportunities for him to still move the needle, I suppose. But it definitely sounds like you think that the Trump effect is fully baked in at this point, finally. I mean, there's not – are there other things that Trump can say or other policies that he can come forward with that you think could move the market that maybe we haven't discussed or thought of?
Yeah, I mean, he could further lower corporate tax rates. I know there was discussion of that early on in the campaigns. It's at 22 or 20% now, 21% now. I know he was talking about dropping that to 15. I guess anything's possible. That he's obviously a smart person, and he wants to make sure that we have enough money coming into the Treasury, obviously to pay our debt, to pay the bills, because he wants to lower deficits. Scott Bessent, the new Treasury Secretary, I think is going to do a phenomenal job. I think he's an absolute just whip smart guy. He's more concerned with collections than he is politics, and he said that in his confirmation hearings. So I think there's going to be, and he's going to issue longer date bonds, maybe 50-year bonds, to sort of kind of help soften the debt repayment schedule, if that makes sense. And I think that's what he wants to do. But I mean, we're looking at Q4 earnings estimates are for 62.18, right, for this quarter. The year end, December 31st, that estimate was 61.52. So we're seeing revisions up on quarterly earnings, which we don't get that very often. I mean, it's not that it never happens, but normally the revisions kind of come down. I would say it's only about 30% of the time that we see revisions up, especially, I would say this is up about 2% over the course of about 2 weeks. Typically, we see earnings outperform. My guess is we're going to have our general call for Q4 earnings is about $64 a share for Q4 and probably $65 for Q1. Okay, $270 a share for 2025. We'll see where these come in, and obviously we talked about this for 2026. About $310, $315 a share. So there's a lot of earnings growth that has to happen, obviously, to continue to justify this 22 plus multiple. Okay, in the face of a 4.5+% interest rate regime, and how much of that multiple includes, 2 cuts, right? If we don't get 2 cuts, if labor comes in tight, right? If we get, next month, the jobs number comes in at, 250, 300, 350,000 jobs, or we get 8.5+ million job openings, right? Next month, you could see that yield go above 5. That yield goes above 5. Okay. This thing's going to come off through. I'm not saying it's going to crash and all this other stuff, but that 22 multiple is going to come. I think it's going to come right down to 20. Okay. And you could see a quick 500 S&P points come off this thing. Okay. Yeah. Just because, okay, now we know we can't justify, we have risk-free yields greater than market yield, earnings yields right now. And that normally is not a very healthy relationship.
And you're talking earning yields, not dividend yields. That can be something that dividend yield is something that probably gets a little bit more talk than earnings yield. And just to clarify, if a stock is at $100 a share and earns $5 a share and pays a $2 dividend, it's got a 2% dividend yield, but a 5% earnings yield. So if I can get a 10% treasury, or if I can get a 10-year treasury that pays 6%, well, then I can earn more, even including the profits. Forget the cash flow, even the overall profits of the company. I can get more return from a risk-free bond than I can from rolling the dice in the stock market.
Right, because your earnings yield is what's going to grow the stock price.
Right.
So, and that's the multiple is the multiple. So it has to be the earnings yield that's going to grow above that. You look at a market that's at 20 times, it's got a 5% earnings yield. If it's at 25 times, it's got a 4% earnings yield. So we're at 22.5 times. So we got a 4.5% earnings yield right now. We have a 4.6% 10-year treasury now. The S&P, like we've talked about this before, the earnings really, really, really need to pull their weight. If they don't, I think it's going to be, it gets up real quick, or it builds pop. The bad girlfriend shows up, right? So, and back to your yields go up, the market goes down now. That's now good news is bad news.
Right.
So we're in a good news, bad news regime now. So good labor numbers, yield goes up, market might not like that. That's the regime we're in right now. So knowing that we're in this sort of environment, and we're stretched through that. Remember that banjo string?
Yeah.
It's really tight right now.
Yeah.
So if anything sets off the yields, anything sets off the wrong way in earnings, it could come back in a quick hurry. I'm not being bearish at all. I'm not anything like that. I think this market is going to do well this year. I'm 6,800 to 7,200. I think it's going to be a good year. I think earnings are strong. All those other things. Typically, we see the highest multiple. The S&P lives in its highest multiple when the 10 years between 3 and 5%, which is where we're at now. Okay, because obviously that's when the economy is growing well, but interest rates aren't too high. It's when the economy cools off, gets below 3%, 2%, something like that, that the multiples come down because there's not enough economic growth to sustain a high multiple or a decent yield on the 10-year treasury note.
One of the things that the financial services industry does an amazing job of is making these simple things sound complicated. And I think we do it so we can charge more money to answer the problems that we created in our confusing language sometimes. But one of the examples of that is, all this earnings yield, dividend yield, bond yield, putting that in another way, if you just take I think the treasury yield right now is at 4.77. I think that basically equates to about 21 times earnings. If you wanted to put a price multiple on the bond market, you would say it's priced at 21 times earnings right now, right? We do a really cool job of using multiple terms to confuse things, right? So we talk about earnings yield is inversely correlated to stock prices, but earnings yield is also inversely correlated to bond prices. So then that makes it really hard to understand what are we talking about here. Basically, if bond yields go down from here, or their multiple is going up, which makes them less attractive than stocks, and vice versa. So right now, the market's at about 22 times earnings. Bonds are at 21 times earnings.
There's 22.45 for 2025. However, the 12-month, which is the next 12, the 12-month multiple, right, is where we live at, is 22.28.
Okay, and right this very second, 1:45 Eastern Time, January 24th, 2025, the 10-year treasury is 463, which if you take 100 and divide it by 4.63, you get 21.598, so 21.6. So right now you're paying 21.6 times earnings to buy a 10-year treasury and 22.28 times earnings to buy the S&P 500. So we're kind of already there.
We're there. As I said, we have an inverse relationship right now.
Yeah, that's what you talked about on the last show, is that doesn't happen very often. So, and I think that's important. Right now I can make slightly more from investing in the bond market risk-free than the S&P, than in the stock market. But the reason we do that is the bond market isn't going to grow that earnings, so to speak,
Right.
where the S&P or in the stock market you can. So cool stuff, man. Well, our next show will be the first ever live intelligent investment newsletter and intelligent investment. What are we calling that again? Webinar. It will be the first live intelligent investment webinar, which will sort of coexist as our next episode. It's going to be multi-purpose. So we're going to try something totally new and button up and be a little bit more organized and intentional and well behaved. So, are you going to wear a suit and tie?
We won't talk about Mahidabel or Debbie or Tiffany.
Are you going to wear a tie?
I don't know. Maybe.
We're going to have to coordinate outfits there. I can't be showing up looking like Steve Jobs if you're walking in Warren Buffett.
I got a really nice fish tie.
Anyway, so looking forward to that, though. That'll be a really fun recap of the fourth quarter Intelligent Investment newsletter, which is I love the way you do the newsletter every quarter. You have a musical theme. This one was Phil Collins, so we're going to get to dive into some of that a little bit and what that means to the markets, and I think that'll be a lot of fun. So if you're a regular listener on the show, check us out for that for sure. That'll be a lot of fun, and looking forward to it as always.
So we'll have to see what happens next week. Maybe Boeing will surprise us next week and say, "Oh no, we were lying about the $5.46. It's actually we've lost $85.46 or something, and we're not going to make planes anymore."
Well, and then we'll find out how right.
Donuts.
Yeah, and then we'll find out how accurate your prediction was, because if it doesn't move on that, then you're really on to something. One of the simplest bits of advice, and I think this is from Jim Cramer's book or one of Jim Cramer's books, but it says basically when a stock does not go down on bad news, then that's a good buying opportunity, and if it doesn't go up on good news, it's a really bad. You're in trouble. So
right,
that's right. Yeah, exactly. So cool stuff, man. Well, enjoy it as always. See you in a couple of weeks, and have a good weekend, man.
You too. I expect you to start it well and early.
Yes, sir. As always, the Intelligent Investment Show is for your entertainment, education, and general amusement purposes only. It is not intended to be financial advice or investment advice of any kind. Neither Matt nor I or any of our companies or associated entities know anything about your financial circumstances, so it would be unwise for us to tell you what to do with your money. We encourage you to seek a professional if you do have questions about your portfolio or your financial plans. If you would like to reach Matt and his team, you may do so by giving him a call at 702-655-8300 or visiting intelligentinvestment.com. We thank you for joining us. We'll see you next time.